My name is Michael Duke, and on my channel, I talk about a broad range of topics, whether that be personal finance or just my life in general. But on a regular basis, I also post stock analysis of companies that I think are interesting. And today, I'm going to be talking about Visa, ticker V. Very notable stock, very large market cap, 600 billion. If you've been interested in the stock market and been paying attention for a while, this company has probably hit your radar. It's a company that I've really liked for a long time, and I do own a overweight position in this stock, but just feel like it's a good one to talk about. So, as always, today I will be giving an overview of the company, talking about the investment thesis, why it may or may not be a compelling investment for your portfolio. Also discuss some of the narratives and sentiment driving the price action, as well as doing an analysis of the financials, the valuation, and since this is a dividend stock, I'll be analyzing the dividend metrics. I'll also discuss some of the risks with this, and I will give it a grade, buy, sell, or hold. Um, and I'll also conclude by doing some technical analysis of the stock chart. So let's get into it. So Visa is a very large company, as I mentioned before. The market cap is $612 billion. The company is headquartered in San Francisco, and it is really responsible for the creation of the credit card. Um, in sometime in the 50s in Fresno, they launched the first credit card program, and it was a major success. And that has transformed into the largest payment processing company in the world with the largest global market share of payment processing. It operates a network called VisaNet, which is the transaction processing network. It basically allows for clearing and settlement of transactions done with a card. So this company is very simple to understand, I think, which makes it appealing to a broad range of investors. Um, every time somebody uses a Visa branded card and purchases anything, whether that be for personal or business use, there is a credit card fee of which the issuing bank of the card takes a large cut, and then Visa, the owner of the payment infrastructure that settles the transaction underneath, they receive a very small cut. So um, the thesis on this is very, very straightforward. It is a play on spending. It's a play on GDP growth internationally in the markets that it's in. It's also a play on a transition from consumers and businesses using cash or check and migrating over to a digital payment ecosystem where they're using a card. So this company has a long growth runway because the transition to cashless payments is a long secular growth story, and it's not over yet. Um, so I think it's like I said before, it's very easy to understand how this company works. It's basically a toll booth business. It takes a small percentage of every single transaction that's occurring over the network. And you can see how that business model is hyper scalable as long as they continue to have new cards be issued. Then they essentially capture market share, but also on the cards that are currently in circulation that are on the network. As spending goes up over time, they receive a larger and larger revenue stream. And furthermore, in a sense, their revenue stream from each additional card is inflation protected. It may be true that if inflation is runaway, that consumers and businesses have less real wealth and income and the resources to spend. However, because they're taking a cut of transactions. They are protected from inflation in a sense. Um, so it's not just a play on consumer spending, which I think gets pigeonholed into. It's a play on all spending of which the payment channel is utilizing VisaNet. So very robust economic moat, very wide around this company. Um, in fact, I would describe their moat as virtually impenetrable, at least at this stage in its cycle. So at the beginning, when it was created, it was created that VisaNet was created by Bank of America, right? And it was essentially research and development. The Bank of America wanted to, they are responsible for the creation of VisaNet. But what happened then is it essentially became a co-op. In fact, why don't I should we should read the Wikipedia page. And yes, for the skeptics out there, no, see, I actually have to. For the skeptics out there, yes, I do utilize Wikipedia for information, much to the chagrin of my former teachers and college professors. So, as I said, Visa was founded in 1958 by Bank of America as the Bank AmeriCard. In response to competitor MasterCharge, Bank of America began to license the Bank AmeriCard program to other financial institutions in 1966. Bank of America owned it. They began to license the technology. But once they kind of saw what it could do, they believed that there was more value of it for it to not be owned and monetized by them. It was more valuable due to its really potential to be central to the payment ecosystem. It was a good idea to give up control, as they state here, and form a co-op, as I was saying, with the other banks, of which it was then renamed Visa in 1976. So here's the deal with this company. It operated as that co-op for many, many years, with the issuer banks. Until I believe it was 2008. In 2008, it was restructured as a publicly trading company, and it IPO'd at that time. And don't quote me on this, but I do believe that the IPO was the largest in history. Prior to October 3rd, 2007, Visa comprised four non-stock separately incorporated companies that employed 6,000 people worldwide. So non-stock, in other words, not really for profit, but not really in the sense that the banks were monetizing their investment. Yeah. So here, October 2006, Visa announced that some of its businesses would be merged and become a publicly traded. Under the IPO restructuring, Visa Canada, Visa International, and Visa USA were merged into the new public company. $10 billion IPO, March 18th, 2008. 406 million shares at $44 a share, raising 18 billion in what was then the largest IPO in US history. So from 18 billion to today, a $612 billion company. Just think about that for a sec in terms of performance. Here, just in price return, that equates to a 1,851% increase. So this stock has been a strong performer in its brief trading history. This article does not really make clear why it IPO'd, but I think the purpose of that is the industry it operates in is fairly oligopolistic, between Visa and MasterCard. And then you also have the closed loop payment networks like American Express and Discover. So the barriers to entry are enormous. Visa having the large market share that it did and does today, it does introduce some regulatory risk, and having it be a standalone publicly traded company allows it to one, drive shareholder returns, but two, be able to self fund and fend off these regulatory uh, threats. It's constantly being sued by the Department of Justice, and there's all this uh, court action with this company and Mastercard. It's not a loved company by the people who have to pay a lot of the fees, and so it being a standalone company was a better framework than it being a co-op because it could really drive a bunch of value and create a bunch of cash flow that it then would be able to return to shareholders, that the banks could hold the shares on their balance sheet and monetize it that way, but also to allow it to be more impenetrable from threat. So is that you know detailed somewhere? Maybe, but that's just more of the logical basis in my mind of why it became a standalone company. So we've already discussed somewhat the thesis behind it, and I'll just restate that. The thesis behind this company is that it is a play on two things. It's a play on just economic growth over time and more spending and capturing a little tiny sliver of each of those payments. But also, it's a play on a larger percentage of payments to occur on their network, right? So not only is it a play on them having this large market share and an impenetrable moat and taking just a little sliver of all these transactions, but also on a transition to a cashless society. So it's really benefit, and I believe will continue to benefit from long-term secular growth. In fact, why don't we look up what is the volume of the Visa network? According to Visa's latest annual report, the total volume of the Visa network is approximately $15 trillion. Think about that for a second. $15 trillion are passing through the payment network. At least that is for the year. I see here in the snippet of the annual report, fiscal year 2024, total volume 14.14. So, yeah, that is on an annualized basis. So, if we then jump into how that translates into the financials, we see here in the trailing 12, and again, I'm not exactly sure what year that corresponds to, probably this year here, September 2023, 32.5 billion of revenue. So I'm not going to do that math for you, but that is a very, very small percentage of the 15 trillion in volume. So that just kind of illustrates the tiny crumbs that trickle down into this corporate entity from the massive, massive volumes in the payment network. So let's talk about their financials. Just right off the bat, what a beautiful, beautiful looking chart or table here. So September 2015 to the trailing 12, 16 billion to 36 billion. That's almost a triple. That's almost a 200% increase. We see gross profits here, 13 billion to 35 billion. That is outstanding. Also, almost a triple. You see here revenues being 36 versus gross profit being 35 billion. The gross profit margin on this company is phenomenal. I mean, that's somewhere in the high 90s%, right? So super strong business model, right? All these resources were put together to create the network at its inception, and now the network exists, and it does not take immense amounts of investment to run the network. In fact, we see here the cost of those revenues being 778 million in the prior year. So the cost required to operate that network very small, and in fact, you see here the cost of revenues going from 474 to 778. So the cost of those revenues has not doubled, has not even doubled in this time frame, while revenues have almost tripled. So that just gives you an idea of the massive scalability and lucrative nature of this business model, right? And then we go into their gross margins here, operating income from 9 billion to 24 billion. Again, that's not quite a triple, but almost. So I see almost identical growth here from in their gross margins and their operating margin. So a company like this, what are they actually spending their OpEx on? They're spending it on SG&A, so salaries of their employees, office space. Maybe office space comes through liabilities on the balance sheet. Anyways, I'm not an accountant. Don't listen to me on that. They're spending it on people. They're spending it on marketing, right? And we'll look at the earnings report to get a better breakdown of that. So earnings from continuing operations here, they are seeing more than a triple, 6.3 billion to almost 20 billion here. So that's more than a triple in their gross profits. So not gross profits, they're essentially net profits. Their earnings are accelerating faster than their gross profits. Very strong sign. The big thing to note about this company is that they generate tons of free cash flow, and they return a substantial majority of their free cash flow to shareholders, almost all of it. In fact, we see here that their shares outstanding from 2.4 billion shares to 1.9 billion shares over a 10-year time frame. That's roughly a quarter of their shares being retired. Earnings per share, their profits have almost tripled, but their share count has reduced by 25%. So their earnings per share should be more than a triple. In fact, we see here from 2.3, $2.30 a share to $8.07 a share. That is somewhere between 3 and 4 times. So that insane cash generative model. There's a ton of free cash flow left over. They're buying down shares and they're paying dividends. We see here the dividend per share was 50 cents a share and is now $2.15 a share. That's more than a quadruple. So this payout ratio being 21.36 in the trailing 12, it's a little deceptive because of how much cash they are returning to shareholders between buybacks and dividends. Very good looking income statement, phenomenal looking income statement. In terms of their balance sheet, they have 12 billion of cash and 3.2 billion of short-term investments. So 15 billion of cash and short-term investments. And when we look at that versus their long-term debt, 21 billion of long-term debt, the balance sheet is very, very healthy. While they do not have enough cash to pay off all their debt at one time, again, if we look at their income statement, they're generating enough earnings from continued operations in a single year to essentially pay down the entirety of their debt or close to it. Very strong looking balance sheet. And we see that they are retaining a lot of earnings. So, what's the problem with this company and this valuation? Well, very purely put, the multiple that the market assigns to this business is objectively high. I think it trades close to a 30 price earnings ratio, but they don't own a lot of assets. Obviously, the intangible asset of the payment network, and arguably that's a tangible asset, but we won't go into that. They own the payment network. That is the asset that they own. The book value of that asset is so low compared to their enterprise value and their market cap. And in terms of cash per share, they have $6 of cash on hand per share. So when you're investing in this company, you don't really have a strong claim to any sort of underlying like cash or factories or buildings or any sort of assets, right? You're paying a high multiple on this just extremely lucrative business model. And so that's something to be aware of when you're taking a look at this company. So let's take a look at the valuation while we're on that topic. Seeking Alpha gives it an F grade. And again, we looked at the financials. They look phenomenal. I don't think that it's absurd that this company is trading at such a high valuation. We see here price earnings gap and non-gap hovering around 30 times. The price earnings growth ratio hovering around 2. That's not that bad, but it is high also. Not as high as some of the other stocks that I've looked at lately and recommended as a buy. Here's where it really highlights what I was just mentioning. So the enterprise value to sales ratio and price sales ratio is very, very high. I mean, there's a lot of like high flying, high growth, early stage companies and growth stocks and whatnot that are trading, at multiples above this, below this. I think that when a company is experiencing massive growth, for it to trade at a price sales ratio of 10 is reasonable, but that's a lot, especially given that companies shouldn't trade on a multiple of sales. So if the price sales ratio is egregiously expensive, being 16, 15 times, and then like I was saying earlier, the price book ratios are also egregiously expensive because again, this company is asset light. It doesn't own assets that in its current corporate structure it invested significant money into. So the price of it, the value of it is purely on the income stream that it produces. And there are plenty of stocks out there that have nowhere near the business model of this. In fact, I covered a stock that is completely different than this yesterday, Nutrien, a fertilizer producer based in Canada. Their price sales and price book ratios are both just below 1, right? So that's a compelling buy for a company like that has mines and processing facilities and has all these like assets that they've sunk all this capital into. So the price sales, the price book ratio of this company, objectively very, very expensive, but not necessarily concerning given the business model. Um, and we see here that the dividend yield also receives an F score, being 0.69%. So let's talk about the dividend for a second. Before we move into that, the valuation, yeah, this is a very expensive stock. We'll look at the valuation over time. It has always tended to trade expensive, and again, it's just because of the strength of the business model. So, do I think it's overvalued or undervalued? We'll have to do a little bit more analysis to evaluate that here shortly. But before we do that, let's look at the dividend yield or dividend metrics. So the forward yield 0.76%. They did recently increase their dividend, I believe, by about 13%. Their 5-year growth rate of 15.41% on the chowder number on this stock. Again, if you're assuming lower growth in the future, it's still in the low to mid teens, double digit. As for how that compares historically, I mean, let's just take a look at the dividend yield over time. Over the last 10 years, the current dividend yield is on the higher end. It's slightly above average, right? I think the average probably falls somewhere in this, zero point 0.6 something range. So it's not undervalued from a dividend yield perspective. It was a few months ago and a few months before that. However, um, the dividend yield is fairly attractive on this company. This is where it really starts to sink in how much this company's grown their dividend over time. Again, it's only been trading since March 2008. If you would have bought it at the IPO, your yield on cost would be 14%. Pretty darn good. Another component of the valuation that I want to mention, the free cash flow yield being below 4%. So this company, it's very free cash flow rich in terms of the business model. You will pay for it. that's a low free cash flow yield. It's not the lowest in the market today, but it's not necessarily of value. And why is it trading at such a low yield? Well, again, it's because of the growth and the degree to which they're returning capital to shareholders. We see here that the compound annual growth rate of the last 10 years, 17%, last 5 years, 15%, 17 over the last three. Seeking Alpha is assuming that the dividend per share will slow down the growth. They're assuming 11% in the forward year. I do believe that the dividend per share will not increase at 15, 17% out in the long term. However, I do expect a low teens double digit dividend growth from this. And this is what I was just describing earlier, return on net tangible assets. It's just asset light. They have a phenomenal returns on assets. So the dividend safety of this company is incredibly strong because their revenues and their earnings are just so robust. Their margins are so strong, and they have a low payout ratio. And they have a decent amount of cash per share. Again, not compared to their valuation, but compared to their dividend. They have enough cash per share to essentially pay out their dividend for 2.5 years without making any money. That's not bad. We see here the payout ratio has remained low over time. So I think it's fair to say that this company, it appeals very, very strongly to dividend growth oriented investors. We see here, if you would have bought at the IPO, it would have immediately began returning capital in the form of dividends, 3 cents a share, split adjusted to 59 cents a share today. That's almost a 20x in terms of growth. That is phenomenal. So, um, yeah, I hesitate to call it an income play because the income is so small, but you can imagine if you had 10, 20, 50, $100 million invested in this one company, that you would have a large income stream and it would be increasing rapidly. So this company is appealing for a number of reasons. The valuation is expensive, but is it fair? Let's take a look at some of the valuation metrics over time. Notably, the price earnings gap ratio over time. We see over the last year, it's kind of traded flat. It's on the high end of where it's seen in the last year. The valuation has traded sideways on a price earnings ratio basis the last 3 years. In fact, let's zoom out a little bit more than that. Let's go out 10 years. You see here that the PE ratio is actually on the lower end of what's been seen historically. And if we zoom all the way out um, to the max chart, again, we see some volatility here. And that could be for accounting change reasons or other reasons, but I won't go into that or speculate on that. I would rather like to discuss that the multiple on earnings that it's trading at now is not egregious compared to where it's been historically. It's not cheap, it's not expensive. The stock is objectively expensive by several metrics, but on a relative basis, the valuation, especially compared to the last 5 years, is below average. So is it overvalued? I don't think so. Is it undervalued? I don't think so. I think it just looks to be at a fair price. And is it okay to buy something at a fair price? I absolutely believe so. I don't think that you should always be seeking to invest in things when they're at some bargain price. We see here it's essentially at an all-time high valuation. I've been invested in this company for several years now. I wish I would have bought it earlier. It's been a good performer. However, and I'm going to use total return here when doing this. However, one thing that investors or potential investors should be aware of is that the company over the last year, in fact, let's go to year to date. The company over the last year to date has underperformed the S&P 500. It's underperformed the S&P 500 over the last year. Over the 3-year time frame, late 2021, it's outperformed pretty significantly. On a 5-year time frame, it has underperformed. On a 10-year time frame, it has massively outperformed. And over even with only about half of the trading history of the index, it still has outperformed over the last 30 years, right? So, in other words, if you would have never invested money in the stock market from 1994 all the way up until 2008, and you put 100% of your money in Visa stock, you still would have outperformed the S&P 500. So I think um, the performance is somewhat of a question mark because it has all the makings of a strong performing stock. However, the performance over the last 5 years has been somewhat of a question mark. And you see that its correlation to the index is fairly strong. It doesn't really exhibit any sort of inverse correlation during bear markets. It's essentially a market performing stock in terms of its trading behavior. So I think that is something that is important to acknowledge when investing in this company, is to really ask yourself, why has the company underperformed versus the broader market? I think there's several things driving that sentiment wise, some probably more material than others. So let's think about what has driven sentiment in the last few years. You have cryptocurrency, and most notably Bitcoin, have really seen an explosion in their market cap and value. Um, I think believers in cryptocurrency, true believers, they believe that it is a competitor to the legacy financial system, to the payment network. Bitcoin, Ethereum, so on and so forth, they are not only forms of currency, they are payment networks that allow for exchange to occur. And so I think Visa, its competitor MasterCard, they've suffered from market sentiment, the participants in the market comparing them to cryptocurrency. Um, I don't believe that that is a material risk. And the reason that I don't believe that is because of the taxation of cryptocurrency transactions. While that may change in the future, in fact, President-elect Donald Trump has. I've seen rumors that he planned to eliminate capital gains taxes on cryptocurrency transactions. We will see what happens there. But right now, if I want to use Ethereum or Bitcoin or whatever as a currency, not only does the merchant have to accept that form of payment, but let's say that I bought a Bitcoin for $1 and then I go into a store and buy a coffee mug for $5. If I exchange my cryptocurrency for that item, I now have incurred a capital gain of $4. So that those mechanics somewhat dampen the usage of Bitcoin and Ethereum and others as a form of payment. Even if the capital gains thing goes away, I still think that that risk from cryptocurrency is very immaterial. And the reason is that Bitcoin, I'll just focus on Bitcoin for a second. Bitcoin is essentially a form of hard currency. It's not inflating at the rate that the US dollar supply is, for example. And furthermore, at least right now, Bitcoin has a fixed supply, of which not all of it is in circulation, but in theory, at will at some time. The network is mutable, however, but we won't get into that. So when something is hard currency, when it has a lower inflation rate, like gold, Bitcoin, etc., then the currency in circulation, like dollars, market participants are incentivized not to spend it, but to hold on to it to insulate themselves from inflation. And that's exactly what you see. So I do not believe that cryptocurrency is a viable competitor, at least based on what I can see now. I do not think that it is a viable competitor to Visa and MasterCard at this time. And furthermore, I'm not saying that cryptocurrency doesn't have value, but it's not really a threat as a currency. It's more of a competitor with something like gold, another form of hard currency that people are incentivized to hoard and hold on to insulate themselves from inflation. So that being said, I do believe that sentiment around that has depressed the trading momentum of Visa stock over the last few years. Another thing that has really hurt the company is so here, um, September 2019, September 20, you do see a slight dip in revenue due to the COVID crash. So, what's been going on in the market the last few years is that the COVID crash happens here. And then what happens after that is there's basically been what somebody, I think this analyst, this talking head personality, her name's Kyla Scanton, I believe is her name. She described what's been going on the last few years as a vibe session. In other words, the economy has not been in a recession since that very brief COVID-induced recession. It has been in an expansion, but a lot of people out there, due to inflationary pressures, interest rates going up, all of these very, very negative economic sentiment. Um, there's been a lot of belief in the market the last few years that a recession is coming. I've seen people on the internet say that we're in a recession when we clearly are not. When we objectively are not in a recession, people have still believed that we are. So this company is cyclical. This company is susceptible to increases and decreases in consumer spending. And consumer spending and inflation have been at the forefront of the discussion the last few years. And I think that that sentiment has weighed on the stock price. And then you also have the fact that the firm is being scrutinized by the Department of Justice right now in an antitrust lawsuit. So all of those things have weighed on the price, and really, I think that has driven the underperformance. So while the sentiment on this stock is still very strong, it still has a strong price, it still trades at a strong multiple. I believe that it is somewhat mispriced. Do I believe that it's undervalued? Not necessarily, but I do believe that sentiment over the last 5 years has been lower than usual on this stock, and I find that interesting. So let's talk about the risks. Well, the risks here are, and I'm going to go back me up here to something I saw on Wikipedia. Visa is the world's second largest card payment organization after being surpassed by China UnionPay in 2015. However, because UnionPay's size is based primarily on the size of its domestic market in China, Visa is still considered the dominant bank card company in the rest of the world, where it commands a 50% market share of total payments. So what's a very clear risk? Well, there are certain jurisdictions across the world that are very opposed to Visa, MasterCard, so on and so forth, coming in and dominating the payment infrastructure of that company. And countries like China, I believe India has one. They've either, whether it's privately owned or state owned or state sponsored, they have created their own payment networks. And basically, those companies are mitigating somewhat the market share growth of a company like Visa. So that's a risk. Another risk here is that the best thing about this stock is also the worst thing. You see this margin profile, you see how much money they're making. There is so much money in this business that it is no wonder that companies are coming out all the time um, to try and destroy the moat that this company has. It's just been a thing. They're always facing threats, whether or not those are legitimate threats. However, I believe is debatable. And again, I think that one thing that a lot of people maybe don't understand about Visa, Mastercard, so on and so forth, is because they own the infrastructure underlying so much of the traditional card system, that competitors are trying to get a slice of the payment ecosystem. However, they often have to align themselves with Visa or MasterCard in order to monetize their products. So, a good example of that is PayPal. PayPal has been seen as a alternative to using um, a card to pay for things, and it is in one sense. But just as an example of what I'm talking about, PayPal has a debit card that's linked to the PayPal balance. The PayPal debit card uses MasterCard's payment network. In other words, they have to, in order for people to utilize the PayPal Mastercard, Mastercard is still monetizing PayPal's ecosystem. Another example of that is Apple Pay. And you see here, this is very easy information to ascertain. Does Apple Pay use Visa or MasterCard? No, Apple Pay is not a Visa or MasterCard, but it can be used with both. So if you've used Apple Pay before, you do know that you place your card into Apple Pay, assuming that it can be used, and you use that, and it's a contactless. So you're not using the physical card, but you're still using a card, and you're either using a one of the cards in your wallet, which might be Visa, MasterCard, or American Express. The Apple Card itself is a MasterCard, Apple Cash, a virtual card number that can be used anywhere Visa is accepted. So Apple Pay is not a competing entity with Visa or MasterCard. It is actually a revenue driver of growth. Let's just look at the earnings report, the most recent earnings report for Visa, October 29, 2024. Very strong numbers. Net revenue up 12% on a nominal dollar basis, and on an adjusted constant dollar basis. Um, because they're buying back shares, that's translating into a high teens earnings per share growth. Very strong. Key business drivers: volumes up 8%, cross border volumes up 13%, and 10% in processed transactions. Transactions up 10%, volumes up 8%. So people have spent just a little bit less money per transaction over the last quarter. But nonetheless, all of these numbers are very, very, very strong. And we see here the total cards: credit up 4%, debit up 8%, total up 7%. Um, let's take a look at this real quick. I won't dive into this too much, but both Visa and MasterCard are investing in new, what they call value add services. So monetizing the data in their payment infrastructure to utilize for anti fraud purposes, to drive accretive acquisitions of other kind of components of the payment infrastructure that they can bolt on and utilize. That is a major growth driver for this. However, I don't really think that one needs to understand in depth the value add service component to believe that this is a good investment purely off of the main driver being volumes increasing over time and the cashless transition. So I would urge you, if you're interested in Visa as an investment, that you educate yourself a little bit more about what some of the additional services are. And we see here, these are how they're spending their OPEX. Personnel or employees 7%, marketing is 37%. Or sorry, that's increase. That's an increase. Marketing increase 37%. And we see here litigation. Yeah, so they set money aside for litigation out of that. So OPEX went up 7%, revenue up 12%, EPS up 17%. So this is really a illustration of what I was talking about before. Rounding up of cash by operating activities less capex, so 6.355 billion in free cash flow. Share repurchases and dividends. This is 5.8 plus 1 billion. That's 6.8 billion. So they actually returned more capital to shareholders than they even earned in terms of free cash flow. So just think about that for a second. Think about what that does to your shareholder return. This company is rewarding shareholders massively. That could be a good or a bad thing, right? Obviously, if you're a shareholder, you are benefiting from that shareholder yield. However, yeah, they're using cash on hand to do that. So they're not opting to pay down debt. They're opting to return it back to shareholders. So good and a bad thing. If we just think about what this is, uh, we'll just do some very basic math. 5.8 plus 1 billion, 6.8 billion times 4 is 27.2 billion versus 612 billion. So their shareholder return is 4 point something percent. I think it is pretty notable that the company is returning more than 100% of their free cash flow to shareholders. I don't necessarily find this problematic because of their strong cash position and the strong cash generation of the business. However, it is something that I think investors need to be aware of, that the earnings growth and the strong dividend growth is augmented by the fact that the company is buying back so many shares. So, with all that being said, do I believe that this company is a buy, a sell, or a hold? And I'll give a nuanced take on that. I think it's just a really high quality company, one of the highest quality companies in the world today, with a strong, compelling growth story historically and into the future. I do believe that growth will continue to moderate over time, and it is in a new phase of its business. I believe that we will see slightly lower growth rates going forward, but I don't think that's a reason not to invest. I think that this is a buy. I think it's a very safe bet. The underlying business is very strong, and there are risks, of course, like with any investment. But I believe that all investors should consider adding Visa to their portfolio. That being said, I do not believe that it is a strong buy at the current valuation. I'm speaking more about the fact that I think that just from a standpoint of being an attractive investable company, that this stock really foots that bill well. And it is one of those always buy stocks. I'm always looking to accumulate more shares in this company. However, I'm looking at the technicals here. Very clear and definitive uptrend since late 2022 at the end of the bear market. Technically speaking, the price did break out to an all-time high, but it did not really break out above this trend line. We look at the volume here. Volume's been about average, but nothing significant here. We see this higher level of volume here. That was a little bit more bullish when it was bouncing here. So do I think that where it's at right now is a strong entry point? Not necessarily. However, if I did not already have a position in this stock, I wouldn't really hesitate to buy shares of it here just to get exposure to it. Now, anytime that the stock is trading in a relative value territory where it's butting along the trend line, or if it were to break down further, I definitely would strongly consider adding to my position. This is one of the larger positions in my portfolio. I will say that I do like MasterCard more than this stock. I will go into that on a separate video as to why I think MasterCard is better. But I own both, and I think that there's a spot for both. And furthermore, if you own both, then you have exposure to an enormous amount of market share within that industry. So I graded a buy. It's not a strong buy. It definitely fits the profile of an investment that I'm happy to own, and I can feel very comfortable with the knowledge that it is what I believe to be a very safe, robust underlying business with the stock. So that's my grade, and that's the video for today. I hope that you found that this interesting and helpful. Comment below. Let me know what you think about this stock, and give me more ideas to take a look at. I'd be happy to do that. I appreciate you for watching, and I hope you have a good rest of your day. And until next time, I will sign off now.